Welcome to Finance with Fairbanks, where real-world finance comes to life. Remember to like this video and subscribe to the channel. Hello, my name is Dr. Fairbanks, and in this video we are going to work through some stock valuation calculation problems. Let's go ahead and begin. First up, we have a quotation that is taken from Yahoo Finance, and we want to ask and answer a bunch of questions, essentially extracting all of the potential information that we could gain from this particular stock quote. First up, what is the legal company name? Well, the legal name of the company is the FedEx Corporation. And then the next question is, well, what is the ticker symbol? Remember, ticker symbols are unique identifiers. This allows us to look stocks up if we're using our brokerage account, and allows us to quickly identify the company. So FDX is the ticker symbol for the FedEx Corporation. It then trades on the New York Stock Exchange, the NYSE. And this quotation is coming from the NASDAQ real-time price quotes. The most recent or last traded price is $278.72. However, if we're going to buy or sell the stock, we don't want to look at the last traded price. We want to look at the bid and the ask price within the quote itself. Remember, we sell stock at the bid price and we buy stock at the ask price. This little X800 is just the market depth, or the number of shares being quoted at that particular price. And recall that the difference between the bid and the ask price is known as the bid-ask spread, and it is representative of the liquidity of the stock. Now, prior to the open of trading on this particular day, the prior close was $275.42. It did open up about 58 cents higher this trading day, and that's because obviously stocks can trade after market hours and before market hours. Obviously a lot less liquid then. Let's suppose that we want to purchase 800 shares, all right? So we're going to purchase 800 shares. What would we pay to acquire these shares? Well, again, you buy at the ask price, not the last trade price, but at the ask price. So we're going to take the $800 and multiply it by the $278 per share. And if we do this with our calculator, we'll do this with our calculators here. We'll go 800 times 278, and we see that we would pay $222,400 to acquire 800 shares in FedEx. Now, what if we wanted to sell 500 shares? Well, remember, if we're going to sell the stock, that we receive the bid price, that would be $277.69. So let's see what we would receive if we sold 500 shares. 500 times 277.69. And we find that we would receive $138,845. Right, what other questions can we ask here? Well, we can look at the day's range. It's obviously trading close to its daily high, which was $280. It traded as low as $271.62. Its 52-week range is $234.45 on the low end and $313.84 on the high end. So it's right around the middle, upper middle section of its 52-week range. Its daily volume, this was taken somewhere around 1 p.m. Eastern Standard Time. It's around the average daily volume. So this is the daily volume on Yahoo Finance, and this is the 3-month daily average volume. So on an average day within the past 3 months, there's been 1.61 million shares trading hands. Now, moving to the right-hand side of this quote, we can now look at the market cap. And when we look at the market cap, we can see that FedEx is what we would call a large cap company. So a small cap, just so that we have this information, is a company that trades anywhere from 0.3 to $2 billion. That would be 300 billion, of course. That's a small cap. A mid-cap company would have a market cap somewhere between 2 billion and 10 billion. And again, FedEx is well above that. A large cap company will have a market cap somewhere between 10 billion and 200 billion. And of course, that's where FedEx is. And then last but not least, we have a mega cap, and that's going to be anything that exceeds $200 billion in market cap. Remember, market cap is price times shares outstanding. So we could, if we wanted to, back out the number of shares outstanding approximately for FedEx. That moves us into our next very, very important metric, and that is beta. Beta comes from a regression. It comes specifically from a model called the capital asset pricing model. I know for a fact, and it says here in the quote too, that this comes from a 5-year monthly regression. So they have 60 monthly observations, and it's the returns, of course. But more importantly, what is beta? Beta is a measure of systematic risk. Another way to think about beta is it's the risk that you can, if you're just looking at this particular stock, it is the risk that's associated with the overall market, not the firm's specific risk per se, but the overall market and how its returns move with that market. So if we were looking at the beta of the market, it would be equal to 1. If we were looking at the beta of the risk-free asset, it would be equal to 0. A beta greater than 1 implies more systematic risk, and a beta less than 1 implies less systematic risk. Now, how do we interpret this number? That's a great question. The idea is that based on the regression model, if the market return was to go up 1% in a day, then FedEx stock returns, in theory, would go up 1.18%. That's how we interpret that regression coefficient. So again, it's a little bit more risky. Conversely, if the market returns went down 1%, FedEx would go down 1.18%. It's a little more sensitive to changes in the market because its systematic risk is a little bit higher. Now, moving on, we have the PE ratio. That's the price to earnings ratio. We talked about this a lot in Chapter 3 when we were doing ratio analysis. And remember, the interpretation of this value is an investor would be willing to pay $17.22 for $1 of FedEx's earnings today. And this is, again, the trailing 12-month earnings. Now, the earnings that they had per share was $16.19. Remember, we take the net income divided by the shares outstanding. That tells us the earnings per share on a basic basis. Their next earning date is December 19th, 2024, so they'll report their next quarterly earnings then. And let's look at the next part. This is our dividend analysis. The first part is the dollar part. The second part is the dividend yield. And recall that to get the dividend yield, we take the dollar dividend and we divide it by the price, and that's how they come up with the 2%. But let's suppose that you owned 1,500 shares. So you owned this. And how much would you expect them to receive in dividends over the course of the next 12 months? Well, we would simply multiply that by $5.52 because that's the dollar dividend per share. And that would give us the approximate or the expected dollar dividends to be received over the next 12 months. And, I know for a fact that FedEx pays this on a quarterly basis, so we would divide by 4 to get the quarterly expectation here, but that's okay. We'll do the full annual amount, and the full annual amount is $8,280 in total dollar dividends over the course of the next 12 months. Fair & Co. expects to pay an annual dividend of $2.10 per share next year. That tells me that this is Div 1. It's the dividend to be received exactly 1 year from today. Calculate the expected value of the dividend for year 5, assuming that the firm grows its dividend by a constant rate of 4%. We know the dividend that will be paid is $2.10. We know that dividends grow at a 4% rate, which we're going to call G, and we're trying to find the dividend at the end of year 5. So we're going to take div 1, we're going to multiply it by 1 plus G, and we're going to raise that to the 4. Now, why 4 and not 5? Well, because we don't have the time 0 cash flow, we have the time 1 cash flow. And if you draw your timeline, here's time 1, 2, 3, 4, 5. We have to send it to year 5. That's 4 periods into the future. So our dividend at 5 then is $2.10 times 1.04 raised to the 4. That's $2.46 approximately. Fair & Co. just paid an annual dividend of $1.50 per share. Just paid tells me that this amount is div 0. Dividends are expected to grow at 10% for the first 5 years and then grow by 3% forever. Calculate the expected value 7 years from today. I think it's best in this scenario to draw a timeline and realize that these dividends are in fact growing by 10% all the way to the end of year 5. And again, we're trying to get to the end of year 7, which is going to have a 3% growth rate. And we want to find div 7. So we know the dividend today, or the dividend that was just paid, is $1.50. We're then going to find dividend at 5 because we know for the first 5 years those dividends grow at exactly 10%. So I'll take the $1.50, I'll multiply it by 1 plus that growth rate, or 1.10. I'll raise that to the 5. That is representative of my time 5 dividend. Then I will shift that forward exactly 2 periods at 3%, or 2 years in this case. So the dividend at the end of year 7 will equal that dividend at 5, and we'll multiply that by 1.03 squared, whatever that answer happens to be, and then that will be our final answer. That'll be the answer to this question. So we will take $1.50, we will multiply that by open parentheses 1.1 raised to the 5. That gives us $2.41, or 42 if we're rounding up. We're then going to shift that forward 2 more periods by multiplying by 1.03 squared. And we find that the answer to this question, the dividend at time 7, is $2.56. King Cash Inc.'s common stock sells for $125 per share, and it has a dividend yield of 4%. Calculate the amount of the dividend. Well, recall that the equation for the dividend yield is simply the dividend that will be received in 1 year divided by the current price per share. If we rearrange this formula, we can find the dividend to be received 1 year by taking the dividend yield times the price. So we'll take the $125 times 4%, and we will find that the dividend that will be paid at the end of next year is $5. FF Inc. just paid an annual dividend of $1.57 per share. That tells me that this is, in fact, div 0. Dividends will grow at 4% for the foreseeable future. Calculate the value of the dividend at the end of year 1, the end of year 5, and the end of year 12. Well, we know the dividend just paid was $1.57. So to find the dividend 1 year from now, we will simply multiply that by 1.04 raised to the 1 in theory. I won't write that, but that's how we would find it. We're growing that dividend by exactly 4%. Let's do this in the calculator. So we'll take $1.57 times 1.04, and we find that that's $1.6328. Now to find the dividend at 5 and 12, I'm just going to use div 0. I think that's the easiest approach to these problems in both scenarios. We're then going to multiply them by 1.04. But to find the dividend at 5, I'm going to raise it to the power of 5 because I need to send it exactly 5 periods into the future. And then I'm going to raise this one to the power of 12 to find the value of the dividends 12 years from today. Let's clear this out. So again, we'll take $1.57. We'll multiply it by open parentheses 1.04 raised to the 5. So our dividend at time 5 is $1.91. Let's do this again for the dividend at 12. We'll take $1.57 times open parentheses 1.04 raised to the 12. That gives us a dividend of $2.51. Suppose Josh purchased 100 shares of Microsoft for $355 per share last year. Today, Josh received a dividend of $6.12 per share and sold the stock for $378 per share. Calculate the total percent return, the capital gain percent return, and the dividend yield percent on this stock. To do this, we need the total return equation, which is just the price that we sell it for minus the price we paid, plus the cash flows received, in this case the dividend, all divided by what we paid for the stock or for the asset. That's our total percent return. Now we can break this down into the two parts. So we have the capital gain component, which is just the price you sold it for minus the price you paid for it, all divided by the price you paid for it. And then we have the dividend yield component, which is just the dividend or the cash flow received divided by the price you paid to acquire the investment. So for the capital gain, we take the price he sold it for, the $378, minus the price he paid for it, that's the $355, all divided by $355 per share. Then for the dividend yield, we take the $6.12 and we divide that by 355. So we'll get 2 percentage returns there. Once we have that information, we can add those together, and what we get will be the total percent return, which we can obviously check. We'll take 378 minus 355, all divided by 355. And we see that our capital gain percent return is 6.48%. For the dividend yield, we'll take the 6.12 and we'll divide that by the 355. And we see that our dividend yield in this example was 1.72%. Now, if we do it all at once or add those two percentages together, we would take the 378 minus the 355, that's our capital gain, dollar gain, plus our dividend of $6.12, and then we would divide all of that by 355, and we see that our total percent return was 8.203%. CollectCo pays a constant dividend of $3.33 per share on its preferred stock. Calculate the price per preferred share, assuming investors require an 11% rate of return on their investment. The title of this question sort of gives it away. It's a zero growth model, and we know in the zero growth model that the present value or the price should equal the dividend, all divided by the required rate of return. Notice that there is no subscript on the dividends, and that's because this model implicitly assumes that the dividend today is the same as the dividend next year, which is the same as the dividend in 2 years, and so on and so forth. And that's because the dividend growth rate is essentially zero in this problem. So we'll just take the equation. PV0 is equal to the $3.33, and then we'll divide that by 11%. 3.33 divided by 0.11. And we see that an investor would be willing to pay $30.27 to acquire this investment. Winnie Inc. pays a constant dividend of $4.25 per share on its preferred stock. The preferred shares sell for $80 per share. Calculate the required rate of return on the investment. To do this, we'll just rearrange the formula and to simply take the dividend and divide it by the price. That's it. So the required rate of return on this investment is the $4.25, which is the constant dividend, divided by the $80 price. And we find that an investor is requiring a rate of return of 5.3125% on this investment. Cashco's preferred shares sell at $112 per share. Investors require a 7% rate of return on their investment. Calculate the amount of the annual dividend. So once again, we're going to rearrange the formula, and to do that, we simply take the price times the required rate of return. That should give us the expected dividend on this investment. So we take the $112 per share and we multiply it by the 7% rate of return that's required on this investment. And we find the investor is expecting a dividend of $7.84 on this preferred share. Rayburn Inc. expects to pay a $1.25 dividend starting 4 years from today. The dividends will remain constant after this time. Investors require a 6% rate of return on their investment. Calculate the value of the preferred stock. So we already know from our discussion and lecture that the zero growth model is the perpetuity formula. And this particular example is what we call a deferred perpetuity, because they're not going to pay those dividends, starting next year. It's actually going to be delayed. So let's look at a timeline real quick. And what we know is that the first dividend will be received at exactly the end of year 4 years from today. Well, when we use these models, we're always valuing the stock, common stock, preferred stock, 1 period prior to the dividend. That means that when I use this perpetuity formula, I'm finding the value of the stock at time 3. So this is a multi-step problem. The first step is to find the value of the preferred shares at the end of year 3. That's because we're using the dividend at 4, which happens to be $1.25. There are no other dividends on this timeline. Please keep that in mind. And then we're going to divide that by the 6%. That will be representative of the price of the stock at the end of year 3. So to find the price today, we have to take that answer, whatever that value is, and we have to discount it back exactly 3 periods at the required rate of return of 6%. So we'll take that $1.25, we will divide it by the 0.06, and we see that at the end of year 3, the preferred shares are worth $20.83. However, we're trying to find the value of it today, so I'm going to divide that then by, open parentheses, 1.06 raised to the 3rd power, because it needs to come back 3 periods, and we find that the price of the preferred shares today is $17.49. King Inc. just paid a dividend of 85 cents per share, so that's Div 0. And dividends are expected to grow at 3.8% forever. Investors require a 12% rate of return on the investment. Calculate the price per share for the common stock. Now, as the title of this slide says, the equation that we need is the constant growth model, which is the price of the stock today is equal to the dividend paid next year, all divided by R minus G. But the problem is we don't know div 1, we just know div 0. We can rewrite this formula then to say div 0 times 1 plus G, that's the numerator because that is div 1 as we saw earlier, divided by R minus G. So the numerator of this problem is 85 cents times 1 plus the 3.8% growth rate, or 1.038, all divided by 12% minus the 3.8%. That will give us the answer to this problem. Again, very, very important that we pay attention. Are they giving us div 1 or are they giving us div 0? Because if they give us div 0, we have to adjust it. We're going to take 0.85, which is div 0. We're going to multiply that by 1.038. That gets us to div 1. And then we're going to divide that by open parentheses 0.12 minus 0.038. And we find that the value of this common stock is $10.76. Cashco will pay a dividend of $6.21 per share next year, so we know that this is div 1 now. Dividends are expected to grow at 5% forever, and the investor requires a 10% rate of return on this investment. Well, this one's much easier because we don't have to adjust the numerator. We just take the dividend at time 1 and simply divide it by R minus G, or 10% minus the 5%. So we take 6.21, and I'm just going to divide it by 5% because that's 10% minus 5% is 5%. And we find that this stock is worth $124.20. JC Pine's dividends grow at 3.75% per year. Investors require a rate of return of 12.1%. The stock is currently selling for $51 per share. Calculate the dividend yield. Now, what we need to recall is the relation between the constant growth model and that total percent return equation. And so we know total return as it relates to the constant growth model is equal to R, and the capital gain, or the price appreciation, is equal to G, and the dividend yield is equal to R minus G. So in this problem, they give us G at 3.75%. They also give us the required rate of return of 12.1%. Knowing this information of how it relates to the model makes solving this problem rather easy. So we just take the dividend yield as R minus G, or 12.1%, minus the 3.75%. So we'll take 12.1 and we will subtract off the 3.75, and we find that the dividend yield in this problem is 8.35%. League One Co. will pay a dividend of $3.12 per share next year. Again, that is div 1. The stock currently sells for $55.25 per share, and the required rate of return is 11%. Calculate the capital gain on this investment. Remember that the capital gain is equal to G. So what that means is we need to rearrange this formula of the constant growth model and solve for G. Thus, G is equal to R minus div 1 all over the price that we would pay to acquire this investment. Plugging this information in, we know div 0, we know R, so G is going to equal the 11% minus 3.12 all divided by 55.25. So we will take 0.11 minus, open parentheses, 3.12 divided by 55.25, and we find that the dividend growth rate in this problem is 5.35%. Smarty Inc.'s stock sells for $108 per share. The company will pay a dividend of $3.54 per share next year. That's Div 1. Dividends are expected to grow at 3% forever. Calculate the required rate of return on this investment. Once again, we'll rearrange the formula. We can actually rearrange the formula from the prior example and see that the required rate of return is equal to the dividend at 1 divided by the price plus G. So in this case, we take the $3.54 dividend, we divide it by the $108 price, we add the dividend growth rate of 3%, and what we will find is the required rate of return on this investment. So we'll take the 3.54 divided by $108. We'll go ahead and add the 3%, and we find that the required rate of return on this investment is 6.278%. Lavelle Inc. plans to pay a dividend of $2.20 per share next year, $2.25 at the end of year 2, $3.10 at the end of year 4, and $8.50 at the end of year 6. No additional dividends will be paid, and investors require a 10% rate of return on the investment. Calculate the value of the stock. Obviously, this is a non-constant set of cash flows. We talked about this back in Chapter 5 in Time Value of Money. We can set this up with all the dividends and their appropriate subscripts. So we're just identifying the information in the problem. I think the best approach is just to use your cash flow worksheet in your calculator. So we'll go ahead and set this up. So C01 is going to be this $2.20. C02 is going to be the $2.25. We will make C03 equal to 0. C04 will be the $3.10. We'll go ahead and make C05 equal to 0. And then C06 will be this $8.50. Now then we'll go to our NPV worksheet once we enter these cash flows into the cash flow worksheet, and we will set I equal to 10, and we will find the present value of this non-constant set of cash flows. Go into my cash flow worksheet. Let's go ahead and clear this out. So CF0 is 0, C01 is $2.20, C02 is $2.25. Now this is where it gets interesting because there is no time 3 cash flow. I'm just going to hit the enter button and notice that that stores the 0 on the timeline there. We'll arrow down to C04, we'll type $3.10 and hit enter. Same thing with C05, we're just going to hit enter and set it equal to 0. Last but not least, we'll enter in that $8.50 for C06. Go over to our NPV worksheet, type 10 and enter, arrow down and compute, and we find that this investment would be worth $10.78. Okay, Old Station Co. has earnings per share of $2.67. The comparable or benchmark PE ratio is 27. Calculate the price per share. Well, recall our equation says that the estimated price is simply equal to the company's value of EPS, or whatever metric you're using, times the benchmark ratio, or comparable PE. In this case, we have a $2.60 earnings per share. We have a benchmark ratio of 27. When we do this in the calculator, we will get an estimated price per share for this stock. So we'll take 267 times 27, and we find that this stock is worth $72.09. Campbell Co. has sales of $900,000, cost of goods sold of $480,000. The company has 85,000 shares outstanding, and the market value of the stock is $15 per share. Calculate the price to sales ratio. Recall that the price to sales ratio is simply the price of the stock divided by sales per share. So what we need to do first is we need to find sales per share. And sales per share are going to be the 900,000 in sales divided by the 85,000 in shares outstanding. Once we get that information, we will have sales per share. And then to find our ratio, we'll simply take the $15 divided by that answer, whatever it is, and we will get the price to sales ratio. Let's do this in the calculator. Okay, so we're going to take the 900,000 divided by the 85,000 shares outstanding, and we see that the the sales per share is $10.58. And so our price to sales ratio, the current price of the stock is $15 divided by second answer, which is what we just did, and that gives us a price to sales of $1.42. Jackson Co. has 300,000 shares outstanding with a current market value of $35 per share. At this year's annual shareholder meeting, 4 directors will be up for election. Assuming straight voting, how many shares would you need to own to guarantee yourself a seat on the board? Also calculate the cost of acquiring these shares. We'll do the same thing using cumulative voting. Let's go ahead and start with the straight voting. And what we know with straight voting is that it requires 50% of the shares outstanding plus one more share to guarantee yourself a seat on the board. So that means that if we take the 300 shares outstanding, we divide it by 2, and we add 1, we get 150,001 share that would be required to guarantee ourselves a seat on this board. And we know that it costs $35 per share. So when we do that math, we should find that the total cost to acquire these shares would be $5,250,035. Now let's look at the straight voting, or excuse me, the cumulative voting now. Now recall the equation for this. With cumulative voting, we need 1 over n plus 1% plus 1 share, where n is the number of directors being elected in that period. So we're going to take 1 over 4 plus 1, which is 1/5, or 20%, and then we're going to add 1 share. So we need 1/5 of the shares plus 1 in this part of the problem. So we'll take the 300,000 shares that are outstanding. I'm going to divide that by 5 or multiply it by 1/5. Then I'm going to add 1 share, and when I do this, I will find that I need 60,001 shares to guarantee myself a seat on the board if they use cumulative voting. We know that each share costs $35 per share, and that results in a total cost of $2.135. That extra 35 there because we need that plus 1 share. All right, folks, that concludes this video. Remember to smash that like button and subscribe to the channel. Until next time, goodbye.